What should you be doing with your mortgage in 2023? 5-year fixeds, static variables, adjustable rate mortgages, or how about none of these? Home buyers and home owners over the last couple years have really had a tough go of it, dealing with very complex economic and political environments. I mean, let's look at the past couple of years. In 2020 and 2021, we had more Canadians than literally ever before go the variable rate option route, literally missing out on one of the most historical opportunities to lock in low rates. I mean, I think I even broke a Saskatchewan record by locking in a 5-year fixed at 1.39%. And long gone are those days. Back then, and you can go back in my channel and watch some of my older videos as to the rationale as to why I was recommending what I was recommending, we had almost 100% of our clients lock in some kind of long-term financing to take advantage of those historically low rates. And it's not like I predicted the future in order to come up with this recommendation. We just asked ourselves some very logical questions and came up with a very logical answer. So what about now though, now that we're at the beginning of 2023? Should we be looking at more of a variable rate mortgage now that so many economists are predicting we'll be in some kind of recessionary environment by the end of 2023? Or should we be locking in some of the lower rates that seem to be popping up now that people are pricing in that future recession? Well, let's look at variable rates first, especially if people are predicting that there's going to be a recession. Why not take a variable rate and ride the rate curve down? Well, right now, bank prime rates sit at around 6.7%. That means that if you're going for a static variable, that's where your payment doesn't change even as your interest rate does. Those are priced at a little over 6% right now. And if you go with an adjustable rate mortgage, that's where your payments do change as the interest rate adjusts. That's just under 6%. Well, that's a pretty substantial premium compared to some of the fixed rate mortgages that exist on the market right now. If you remember from some of my previous videos, and if you haven't seen those yet, be sure to check those out. We talk about how to perceive fixed versus variable in the sense that it's usually a premium that you're paying for some version of stability. Typically, fixed rates tend to be higher than variable rate mortgages. And right now, the inverse is true. If you go with the variable rate option, you're actually going to be paying a premium for that instability. Basically hoping that rates are going to come down swiftly enough or over the long term enough to counterbalance the fact that you could have locked in a lower rate with the fixed rate product. Now that's not a bet that I myself would be making. Remember what I said about our strategy in 2020 and 2021 about locking in the rates, that we didn't need to predict the future in order to be successful? That's because we were asking ourselves a very logical question. What if I'm wrong? Back then, we asked the question, what if I'm wrong? Well, if we're wrong, then rates stay the same and we miss out on some of the earlier savings that we could have had by going the variable rate options. But if we were right and rates started to climb incredibly fast, like the rate environment that we eventually did see, those that locked in the rates were only sacrificing a bit of savings to hedge against a much worse scenario. Well, in this case, if you take a variable, what if you're wrong? What if rates don't come down like all the economists are expecting? What if we don't end up in a recessionary environment? What if instead rates stay exactly where they are now, or worse, even continue to climb more? You're going to be in a much worse scenario because you already started at a much higher rate. So clearly that must mean that we want to go for the 5-year fixed right now, right? That are under 4.5%? Well, not necessarily either. It's a good option, but not necessarily the best one. So if you do end up locking in something long-term now, you may end up missing out on some future lower rates because the cost to break the mortgage in order to take advantage of those lower rates may be cost prohibitive. And this is particularly true if you end up going with some kind of big bank mortgage that has a bank grade version of the interest rate differential mortgage penalty calculation. Speaking of which, if you're ever at a party and you really want to impress people, just say bank grade version of the interest rate differential and you'll have people literally throwing themselves at you. So clearly, if we're not going for a variable rate type of option and we're not looking to lock in for a long term necessarily, then that would obviously mean that we're looking for some kind of short-term fixed product like a 1 or a 2-year, right? Well, once again, not really. Right now, one of the things that makes this economic environment so tricky is that we actually have something called an inverted yield curve. Typically, short-term money ends up being priced cheaper than longer-term money. If you want a 7-year fixed or a 10-year fixed, you would historically pay a much higher rate than you would for a 1 and a 2-year fixed mortgage product. Right now, though, because we have an inverted yield curve, the long-term money is actually more cost-effective than the 1 and the 2-year fixed. So a 1 and a 2-year fixed, for instance, might sit at 6% as far as your mortgage rate is concerned, but the 5-year product is under 4.5%. This, by the way, is also a really good indicator that we're going to enter some kind of recessionary environment. Historically, in at least 5 of the 6 last times when the inverted yield curve was inverted, we did enter a recession. And this particular inversion is very, very significant and very, very steep. So going with the 1 or the 2-year fix doesn't put you at the exact same risk that variable rate mortgages would put you at least in terms of fluctuating payments if in the event that rates were to go up over the next 24 months. But it does mean that you're paying a premium over these longer term fixed rates, banking on something that may or may not happen, the Bank of Canada adjusting their rates to fight off a recession. So the real answer, at least for the beginning of 2023, looks to be somewhere in the middle. The 3-year fixed. The 3-year fixed looks pretty attractive right now because it doesn't come at the same premium that the 1 and the 2-year fixed and the variables are coming at right now. In fact, the 3-year fixed is only slightly above what the 5-year fixed rates are at right now. And then if you make sure that you get the monoline version of the interest rate differential, you'll make sure that your penalties are nice and low in the event that you have to break it early. So you might end up with a term that puts you in the lowest part of this next rate cycle so that you can lock those rates in for the future. Or if you make sure that the penalty calculations are more in your favor, you can still break the term early to try to take advantage of those lower rates just in case the timing doesn't line up quite so perfectly. Whatever you do though, do not lock in your rate at a big bank. You're going to end up just like those in 2018 and 2019 that locked in their rates with the bank and ended up having penalties so astronomical that they couldn't even take advantage of the historically low rates of 2020 and 2021. They were simply just priced out. Instead, look for non-bank options. And if you want my help, just reach out.